You're listening to the Opal Dividends Podcast with Austin Graff and Adam Muller.
Welcome to the first episode of the Opal Dividends Podcast. I am Austin Graff, and my co-host is Adam Muller. Our goal for this podcast is to use it as a platform to educate investors and advisors on dividend investing and the markets. Adam, my first question is to you. What should investors be watching as we start the new year?
That's an interesting question, right? Because you can go so many places with that. Because it's like I think there's like a top down and a bottoms up answer. Do you know what I mean?
Yeah.
Like at a high level, you got to unfortunately you still have to watch the Fed, what rates are doing, and sort of government policy. And then you could also answer the question from the perspective of what should you be watching about individual companies. And I would say the big thing on my radar heading into the new year is to watch for margin compression. And as this inflation continues to kind of work its way through the system, what are companies doing on the pricing side, and what kind of cost inflation are they facing? Is that going to squeeze margins over the course of the year?
Yeah, I think that's going to be a really interesting kind of story for the year. Last year we saw a lot of companies who had the benefit of increasing prices at a pretty dramatic pace. And we saw them keep margins up for the better part of the year. It'll be interesting, as we've seen some data come out on inflation, how that plays through with these financials or with the financial statements in 2023 is they might not be able to increase prices. How are costs going to flow through income statements, and then how are margins going to react to that? I think that's probably the biggest question as we go through the year from a fundamental basis. But I think you brought up a number of kind of top-down issues that the market's kind of facing right now. And one of the issues that we should probably talk about is just fixed income investors appear to be kind of expecting interest rates to fall in the back half of 23. And the Fed continues to have kind of this aggressive tightening commentary. Like, what are your thoughts on that? And how do you think about positioning a portfolio in an environment of such divergence?
Yeah, I think that's the $1 million question, right? If someone has a crystal ball today and can guess what the Fed is going to do over the next 18 months, 24 months from now, they will be living on their own private island. So you can't do that. I don't think you can do that as a portfolio manager. You can't. If you make a call and you're wrong, you're going to be in big trouble. And that's not how you manage sort of even a concentrated, diversified portfolio of investments. You can't do it that way. So I think you got to maintain some balance and understand. I think the biggest thing for portfolio managers is to understand that Fed decisions and market interpretations of Fed speeches and all of the Fed noise out there can be very short term in nature. And so don't get stuck on one particular moment or action of the Fed, and try to maintain sort of a multi-year view on how this is going to play out and how it could play out, and then have a balanced portfolio.
Yeah, I mean, I think that makes sense. It really seems like you have the two polar opposites right now. We haven't seen this a lot in the last kind of decade or so. It seems like the Fed and fixed income investors have basically been on the same page. As you have the whole mentality of don't fight the Fed. So as the Fed was easing, everyone was assuming kind of rates would go down. I think that the change in tune with tightening has forced kind of fixed income investors to think, maybe the Fed might be wrong, and maybe things are going to go back to the way they were when the Fed's trying to convince them otherwise. And so when positioning portfolios, it's really important not to go with kind of one of these calls, even though you see a lot of people on TV talking about how they think they're right and insisting that whatever their view is the only view. In reality, we have to prepare for both a higher rate environment and a lower rate environment. Understanding the reality is probably going to end up somewhere in between. And so it really comes down to kind of putting together a portfolio that can benefit in both environments, but is really going to excel in kind of the in between. So that makes it makes it harder because I think everyone kind of wants to be in one of the camps because it's comfortable to be in a position where you have a number of people making a similar argument to what you're making. But at the end of the day, to position a portfolio correctly, you got to have kind of a foot in both camps. So it's kind of unique for portfolio management, that something that isn't really talked about that much in the mainstream media. And I think it should be referenced a bit more.
And also, Austin, like, just because if the Fed were to stop tightening, that doesn't mean they're going to start easing.
Right.
There could be a plateau that could last a long time where rates are just at a higher rate than they've been in the last 10, 15 years, but still historically low if you look back over 40, 50 years. And it could just sit there.
Right. Yeah. So there's this, tendency for people in the market to do something. And I think they think that the Fed also has to do something, when my impression is you have quite a few academics on the Fed who are probably just perfectly fine sitting and doing nothing and waiting to see what the data says. So the likelihood that they just reverse course very quickly is probably not going to happen. And if it does happen, we probably have bigger problems than what people are currently anticipating, because it means that the economy is in worse shape than most of the market seems to be saying. Yeah, there's going to be a recession or a soft landing. I don't think in a mild recession the Fed's going to say, oh yeah, we got to juice the economy with lower rates. They likely only do that if they see it being a pretty harsh fall or drop, and that's going to have really negative impact on the underlying financials of the companies. And so it seems like there's some inconsistency in the perspective of those who think that that's going to reverse course. Because if that was the case, you'd be really, you wouldn't be going out on the risk spectrum by buying these risk assets. You'd probably be pulling in a little bit and saying, hey, we're in for a pretty rocky ride here in the rest of 2023. So it's kind of a tough one.
Then you circle back to how you actually put a portfolio together in this kind of environment, right? And it's high quality companies with pricing power, trading at reasonable valuations and if they have with some growth opportunities despite a uncertain kind of economy. And if you can put together a portfolio of those names, a diversified portfolio of those names, you'll probably be okay.
Yeah, I mean, that's the goal, right? And it's really hard to put together one of these portfolios that's going to benefit in multiple environments, right? Because usually there's an environment that a company does really well in, and then an environment that a company does really poorly in. And if you have a view, like let's say you're in the rates are going lower perspective, and technology does really well when rates go down, they're tended to be extremely overweight in these technology companies just because you have this view that technology is going to significantly outperform. That isn't necessarily the way you should be putting together a portfolio. You need to have some offsetting names as well. In this environment, you probably have some value-based names. And also, it's important to keep in mind that just because technology did really well in 2020 when the market kind of took a hit, it doesn't mean that if we have an economic contraction in 2023, that technology is going to be the big winner. I think as we've seen in the news, there's been a number of technology companies who have been laying off people. Generally, you don't lay off people when you think your company is going to do extremely well in the next 12 to 18 months. Usually that's a sign that management teams are expecting some pain in the near to intermediate term. And so I think investors would be maybe benefit from keeping that in mind when they're thinking about allocations.
Yeah, and 2020 was such a unique year, right? That in the sense of, the market obviously had a huge drawdown in was it March, April 2020. And then there was this huge pull forward of demand for companies that benefited from people being at home.
Right.
And now there's an element of some of that is kind of unwinding while there's this inflation and, geopolitical uncertainty on top of everything else, which is the only thing you can say about the current environment with some certainty is that it's going to be volatile.
Right. Yeah, I think that's a good point. I mean, you look at it, it's been a really abnormal kind of cycle.
Yeah.
Because we saw in 2020, you saw technology do amazingly well as everyone was sent home and everyone was ordering, things from home. And I think a lot of people, and we're starting to see the the downfall of this, but a lot of people thought that the world had changed and that people were just going to spend all their time at home. They were going to work from home. They were going to, shop from home. They were going to eat out at home or order in, however you want to say it. And they thought that all of the growth that happened in 2020 and 21 was going to continue for the foreseeable future. And what we've seen in 22 is that growth didn't necessarily come through. Even in the late stages of 21, we saw that not coming through. And interestingly, we're seeing a number of other parts of the economy that are experiencing similar dynamics where, when the world reopens or not the world, because China's still kind of reopening, but when the US reopens, it's probably a great example. You've got restaurants that did amazingly well and they couldn't find enough, help. And it's been well documented that there aren't enough employees. But that's starting to kind of dwindle. And you had the same thing going on with spending in some of the department stores. And we saw a pretty slow spend in 4Q for a number of the retailers. And so I think what we're seeing is it's kind of like the pig going through the python, where you have a number of these situations where people come back and they rush back to the market and everyone's like staffing up to try to meet that demand. And then in reality, that demand is kind of a short-term thing. The demand kind of dissipates over time as people become less excited about like going out to eat or less excited about, buying new clothes to go out to eat. And it turns into, a decline because it can't sustain that level. We could be seeing similar dynamics with the airline industry right now. And I think it's super interesting to hear some of these CEOs project kind of double-digit growth multiple years into the future, expecting just the world to keep traveling at its current pace.
Travel, as soon as you started talking about that dynamic, that my thought went to travel. And, everyone wanted to take those vacations that they hadn't done in a couple of years, but then you go and you take the family to Italy, and then what? You don't go again in 2 weeks, So
Right.
It's a good, this tendency to just extrapolate the current dynamics, years into the future is never works. But it is a way that people get stuck in that kind of thinking.
Right. Yeah. I mean, people always want to extrapolate the most recent results like indefinitely into the future. And I think, as value investors, one of the things we really try to do is say like, what are normalized earnings? What's normalized growth really look like? And when you see a company growing at like 20 or 30%, you really have to think twice. Like if you think about compounding, like how long it takes for that company to kind of take over the world at those rates. And is it likely that company will take over the world? I think in most cases it's not. And then maybe that's a bit of a exaggeration, but it's very hard for companies to grow at these high double-digit rates for any extended period of time.
Yeah, absolutely. And each year you do it, it's harder the next because you're growing off of a bigger base.
Right. Yeah, I guess on that one, maybe we talk about money center banks. We've seen a number of companies start reporting 4Q results, and let's talk about kind of what you're seeing, what your takeaways are from the reports, like what people should be thinking about it as some of these reports come in.
Oh, well, I mean, one thing I noticed that I think was pretty easily telegraphed was just that the capital markets businesses are down.
Yeah.
IPOs, investment, merger advisory fees and things really seem to have dried up towards the end of last year, which sort of makes sense given the dynamic. And then the question is about the health of the consumer and what kind of loan loss reserves are banks going to take in Q4 heading into this uncertainty in 2023, where everyone assumes there's going to be some recession, but how big, how long, when is it going to actually happen, and how conservative are they going to be with their reserves?
Right. Well, the investment banking thing you referenced is another great example of that like sugar high that the market got in 21, right? When they had all these SPAC issues and you heard about, analysts working till, whatever, 6 a.m, which I mean, you used to do that when you were an associate, right, Adam?
Oh, for sure.
Yeah. I don't know what the big deal is, but when you saw that happening, it was pretty clear that wasn't going to last forever. And so now they're laying off a bunch of people, and the market seems to be surprised, but just the way banking works, it's a relatively cyclical business, and it's cyclical in employment as well.
Yeah. Well, also some banks, I mean, I don't want to get too far afield of the topic, but if you have a business, sort of an employee model where you cull the bottom 10% every year, and then you go 2 to 3 years where you don't fire anyone, there's going to be a point where something happens where you have to make that all up because you haven't let anyone go in a couple of years. And during the kind of heart of the pandemic, they stopped culling the bottom 10%, which was actually a very nice thing to do, I suppose, in a lot of ways. And now that's going to happen.
Well, maybe they just need fewer people because the analysts and associates aren't working weekends anymore. I don't know. That may have been an assumption, but I don't think it's going to last too long as we see the market kind of twist from what was a extremely bullish market for many of these banks to being a not so bullish market. And I think this just highlights, when looking at companies, really trying to understand what's generating the underlying cash flows and what's generating the revenue growth for that company. If you look across the banks, different banks have different exposures to kind of investment banking, M&A, and then other exposures to kind of mainstream banking of lending to small businesses or everyday people. And we're seeing kind of a separation in how those businesses are functioning right now. I would say the interest rates are helping the mainstream business, but the volatility, while it might be helping trading, is not helping the M&A business. It's much harder to finance a deal today than it was 12 to 18 months ago. And if interest rates, I think they've come down a little recently, lower rates might help get a deal done in the short term, but interest rate volatility is really difficult because I think Adam and I can both attest to these deals. You don't get the deal done in a couple of days. It's usually months of work. And if interest rates are moving all over the place, the valuation's moving all over the place. And if you work for 6 weeks on it and then it's no longer a viable deal, people just don't want to do that. If they're just going to put their pencils down and wait for things to kind of normalize. So we're seeing some expectations that M&A is going to pick back up in 23. I think the only way that happens is if there are real bargains out there, because as long as interest rate volatility is around, people aren't going to want to do the work.
Well, and banks are stuck with billions of dollars of deal debt right now that they weren't able to then sell to like institutional investors. And you look at like just the Twitter deal alone, you got a bunch of big banks that had committed financing to that deal. And then there was all the shenanigans about, the deal actually happening. And then it happens. And all these banks are holding tens of billions of dollars of debt on their balance sheets that they didn't intend to hold. So that eats up their appetite for the risk they take when they finance deals like that. And of course, rates are higher. So the system kind of gets gummed up and it's harder to get something done, especially something that requires a lot of debt financing and it's a sizable deal.
Right.
I mean, I guess an equity, a stock deal you could still do, I suppose, if you could agree on terms, if you're just doing it for, a merger of equals or something like that. But
yeah, but even stock market volatility is up, right? So
that
kind of play out, it makes it hard. I mean, the M&A space has been in kind of this Goldilocks scenario for, you could say, a decade. It's probably been longer than a decade. As interest rates have come down, banks have been looking for places to put money. You've got the non-bank system that's out there. They've got a ton of cash and they're looking to put it to use. So it's been a really nice market for doing deals. It's unclear what's going to happen going forward. And I mean, you could even go back to like a lot of the deals were done by private equity, and who knows what's going on with those marks, but it doesn't seem like the marks are necessarily adjusting to market right now. It seems like they're adjusting to something else, and it'll be interesting to see kind of how that shakes out.
So what do you think about dividend paying equities in 2023? If we circle back after all that we've talked about.
Yeah, I mean, I always like dividend paying equities because you kind of mentioned there's expected to be a lot more volatility in 2023. And that dividend, while we don't necessarily use it as a valuation construct, it does help reduce that volatility because it does generate some return as companies tend to pay dividends in good and bad times. If you look at kind of the 2000s, the decade from 2000 to 2010, the market was actually negative, if not for dividends. And a lot of that has to do with what happened in 08 and 09. But I think it's just a highlight that in choppy environments, dividend paying equities tend to outperform. And that's because dividends become a more significant portion of returns. I think on top of that, the dividend payers tend to be these higher quality companies that you referenced before, that have solid business models that can kind of operate through a cycle pretty effectively. So we think, I think that kind of bodes well for dividend payers in 2023. It definitely helped them in 2022. But I guess, what are your thoughts, Adam?
Yeah, no, I agree with everything you said, but I also think there's something about a company that pays dividends, or even more broadly, that just has a philosophy of returning capital to shareholders via dividends and buyback, where every dollar of spend on a new project has to be weighed against, or we could give that dollar to shareholders. And I want management teams to have to confront the either or, because it tends to mean that those decisions to spend for growth tend to have not only a higher return, but like a higher probability of success, than if you just never give money back to shareholders and you just throwing stuff at every project that you can think of, because you got to grow and you got to spend, the internal cash flow you're generating.
So are you implying that you're not a big fan of some of these moonshot business units at the big tech companies?
No, I think flying taxis are the way to go.
Okay.
But, no, look, I mean, there is a place for those kinds of investments for sure, because if you don't do that, then there's less innovation and less progress and stuff. But I think there's a way to do that and still be appropriate stewards of shareholder capital. Like, I don't want to name names, but like there are a lot of big companies out there that, look, there's companies that when they close a project or they shut something down and they end up, and it ends up coming out how many tens of billions of dollars it cost. And there is a question of was that, in hindsight, that was a bad capital allocation decision.
Right.
But if it had worked, it wouldn't have been. And so, you do have to take some risks and make some decisions. I just want those to be run through a prism of what are the other uses for this capital, and are we better off just giving it back to shareholders? And you've even seen with someone like Berkshire over the last few years. And they don't pay a dividend, but you go back 10 years ago, no one thought Buffett would ever buy back stock, right?
Right.
And then he acknowledged that the company got to a certain size where it was harder to find things to buy and do to generate the kind of returns. And if his stock is trading below a certain value, the best M&A, the best thing he can do with that capital is to buy back his own company. That was a big sort of sea change in his thinking, or at least how he communicated it around buybacks. And I like that kind of discipline. No reason Berkshire shouldn't also pay a dividend, but
I think it's important to just acknowledge that, Berkshire actually lives off dividends, right? They buy companies that pay them dividends, and that's what allows them to reinvest that capital in other businesses. And the fact that, Warren Buffett happens to be one of the greatest capital allocators of all time is what makes it such a great company. And so he thinks that he should be allocating that capital rather than giving it back to investors in the form of dividends. But I guess with that, let's wrap it up, because I think any good investing podcast should be wrapped up with a conversation on Warren Buffett. So let's I guess that's good. Anything else that you think is important to discuss before we send him off?
Are you talking to me?
Yeah, I'm talking to you.
Nothing that can't wait for episode 2.
All right.
But this has been fun. It's been a good little beginning of the year chat. I've enjoyed it.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.